As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only. Hey guys, and welcome back to the channel. Recently I've been making a few videos about real estate investments, REITs, or just real estate in general, and I am currently just looking for unique opportunities in regards to real estate, and I think I found a pretty unique investment opportunity, and well, that is the Empire State Building, as you can see on this picture here. And the REIT in question is the Empire State Realty Trust. This company is worth about 1.6 billion in market cap right now, but they own a pretty specific portfolio, and well, it's mainly focused around the Empire State Building, and yeah, it's focused in New York City and mainly in Manhattan and in the greater New York metropolitan area. I think this is the acronym for. So here you can get a quick overview of what they own. It's mainly office space. And a little bit of retail. So with the current sentiment around offices not being used that much in the future because of the current crisis we're in, we can understand why this company would potentially be undervalued. If we look at the current share price, which is about $5.45, and if you see where it was about 3 years ago, it was quite significantly higher. So right now you can buy it at like a 75% discount based on share price. So yeah, like we can understand the drop right here, which is obviously because of the crisis we're in, and I am a bit in doubt about these questions, but I think it's because the observatory was under maintenance for quite a while, and obviously that hurts your revenue for a bit, but we'll get to that in a bit in this video. So if we look at the overview of the company, we see that the company is worth about 1.6 billion on the top right here, and yeah, if we look at the 52-week range, we can see that in the past 52 weeks it has been trading on the lower end, comparatively at least. So yeah, we have to see if this company is interesting. Something else you notice is that they don't pay a dividend right now. If we backdate the dividend, and we could assume that they could still pay dividends, their dividend yield right now would be about 7.5%. Their dividend has been growing for about 7% per year for the past 10 years, so that's pretty significant as well. And well, you may think, well, they stopped it, so how can you assume anything like that? They stopped it, dividend payments, but they saw it as an opportunity because they were able to, as they had revaluations, and normally REITs can't, of course. They always have to pay 90% of their rental income, or net rental income, I should say. And they canceled it, and instead they are looking to buy back stock. So they believe that at these current share prices they can return shareholder value better with share buybacks than with dividends, which I guess I agree. If we then look at their key statistics, we see that their 10-year compound annual growth rate, which you see right in the middle, has been pretty decent. Their revenue, which is their rent income, I guess, and the observatory income, has been increasing by about 12% per year, while their asset value has been increasing by about 16% per year. This is obviously a compound annual growth rate, so this is pretty good. If you look at this number, it says price to book value is about 1. I'd say it's a bit lower right now if I look at recent share price compared to their equity. But if you are investing based on book value, you could say that right now it is at around fair value. But if you think about the share price movement that we've seen from the past 5 years, one could assume that for this kind of prime real estate in such a prime location, I might add, people are willing to pay a premium. So that is something to consider. Something else noteworthy here is their debt to asset ratio. Sorry. It's about 0.5, which is not significantly low, but it's also not that high. It's pretty healthy. If we then look at their total assets movement here in the past 10 years compared to their total liabilities, what we see is that their liabilities used to be actually higher than the assets, and if we look now, it's about 0.5. So we see that over the long term, they reduce their liabilities compared to the asset value that they have, which I guess is a positive movement for any company to deleverage while also increasing their assets. So this is a decent sign for the long term. From their presentation, I found several interesting items, and the first one I would like to share with you is the tenant expansion fuel leases. So the tenant expansion actually fuel the leases that are increasing. So what we see in these this graph, I guess, we see that from square foot in 2013, it's, well, based on square foot, it has almost well, I don't even know the number. It went for like 15 times an increase based on square foot, and yeah, we see about a little bit less than 10 in the amount of transactions. But keep in mind that this is not the actual growth. This is the growth that their tenants have. So they keep buying more office space because those tenants have a pretty good growth business. This is pretty interesting to consider because, yeah, if your tenants have a pretty good business, then you can profit from that as well. So total billings collection. So if we looked at previous real estate, especially the Capital and Counties, the Covent Garden videos, we noticed that they were not able to collect any or almost any rent. And right now, here we see that, sure, in the second quarter of 2020 it was pretty low, and then we see the third quarter of 2020 was significantly higher, and now we see in October it has been a bit lower again. But obviously these levels are pretty significant, so this looks pretty decent so far. And at the bottom here we can see how it has been differentiating. So the retail is actually moving upwards and office has been moving upwards and now a little bit down, but that could also be a temporary setback. It's not a small difference as we've seen with Capital and County, so overall this looks pretty steady, and I guess that is to be expected if you own a lot of offices, because these contracts tend to be for like 5 to 10 years normally, and yeah, you need to be pretty fortunate if your office space, your rental agreement, I guess, finishes around these times, and then you also need to think about, okay, do I really not want to have this office space anymore? Which I don't think a lot of companies are considering right now, but we'll get to that in a bit. So here we see the signed lease is not commenced. So what does this mean? Okay, they have already agreed to lease, but we don't have an income of it as of yet. Here we see when the income starts, and we can expect some actual cash received, I guess, from these dates. Two things I would really like to point out here. There's 3 companies actually that are pretty familiar: Uber Technologies, Starbucks, and LinkedIn Corporation. Things that I would like to emphasize is Uber Technologies, because you might think, well, Uber is very focused on technology. Most technology stocks have been sharing with the public that they do not need that much office space in the future anymore, but here we see that they do plan to have office space as of January 2021 next year. Same goes for LinkedIn. LinkedIn is part of Microsoft, and I think we can all assume that they can work from home, but clearly they are going to rent a lot of office space for I guess next year and the year after. So this could already obviously be signed beforehand, and it could be that afterwards they're not going to do it anymore. But I think if you really don't want this office space, you would have somehow paid a fine and got away from the lease contract. So the fact that they still want this, and that's what I assume, obviously it's a bit of a risky assumption, but it's a decent sign. And the fact that they have looked so far ahead of when they need this office space, you can actually kind of see some growth in that company as well. And I think that's pretty interesting to see from a real estate perspective. If we looked at the previous sheet, we saw in the bottom the square feet, and we saw the amount of lease that they were going to get. Here we see the total portfolio vacant space, which is quite significant. I think this is about 20% of the total space, a little bit less, like 15 to 20% about the total space that they have available. So I think that's pretty significant, but as we can see here, a part of it is already signed, leased, what we saw previously. And what I would like to emphasize, if we look at the price per square foot that we've seen in the previous sheet, we can assume that the vacancy, the vacant space could give us between 40 and 50 million in extra revenue, and that is without the signed lease contracts. So that looks pretty decent as well. And obviously this is still being redeveloped and stuff like that, so it might take a while before that happens, but it has some future growth in it without actually acquiring new assets. If we look at the rental revenue, which is just something I would like to look at and see how it moved, here we see barely any movement, but here we see that there is a slow decrease, and yeah, I guess that is to be expected in these times. But all in all, it looks pretty relatively steady. And yeah, in the bottom you can see the total cash revenues. The main interesting thing about this investment would be the Empire State Building. The Empire State Building obviously has office space as well, but I think their main attraction would be the observatory. In this sheet we can see how the observatory revenue has been increasing. And yeah, it comes down to about a 9% compound annual growth rate. And keep in mind that there has been some drawback in certain periods, and here as well. Yeah, you can read this. There were reasons for it. As you can see here, in the first quarter of 2018, they had a $3 million backset because they had to replace the elevator, so it was closed. And yeah, for redevelopment, it was closed in 2019 for about 9 months, which, if you think about it, is pretty hurtful right now. And obviously, you wish that they had waited with this until this year, but you don't know these things up front, of course. And something interesting here as well is that yeah, we've seen a pretty steep decline, and you can compare here the 9 months 2019 compared to the 9 months 2020, and yeah, significant decline. It was closed. The observatory was closed from March 16th through July 20th. So yeah, you cannot get any revenue from it. And keep in mind that the observatory is well, pretty reliant on tourists, because that's where they get most of their revenue from. So that's pretty painful. But for the long term, we can see their growth here, which I think is a pretty decent growth rate. And yeah, right now we could buy it at a discount. And yeah, keep in mind that you can't just get a discount if nothing goes wrong. So you need to look in the long term and see if it is something for you. So what we see here is the growth in observatory revenue per capita. So how much revenue has been growing per person that enters it, so per visitor. And then we see a compound annual growth rate of 7.7%. So not only do they see more visitors, but the amount of revenue that they can collect from a visitor has been increasing as well. So I guess direct sales at full price is largest source, so that will increase. But premium experience, offering capture incremental value, this will also have an impact on it. And yeah, they have redeveloped the observatory as well, so one could assume that because they have made it fancier or whatnot, it would be even more, they could even increase the prices a little bit more. So the observatory, this is basically it about the observatory. Lastly, before I get to the things that I don't really like about this company, they have a strong and flexible balance sheet, which is something that I like to see in a business. So they have some cash, and considering that most of their office space income still continues, I think this is a pretty safe cash position to be on, and they have over 1.1 billion undrawn capacity on LOC, so they could actually borrow some money to invest in other properties if the situation arises. And something else is that yeah, the weighted average debt maturity is 8.3 years, so it's going to be a while, and no debt maturity until 2024, so they don't have to worry about anything in that regard, about talking to banks and so on to fix that. And their weighted average interest rate is about 4%, which isn't very high, but not that low either. There then is a few things that I don't really like about the company. Even though the share price has dropped 75%, we haven't seen, or I haven't seen, any recent insider buying. The insider ownership is available. It's about 0.4%, so one might think that it's a bit significant, but for me personally, it's not that significant. There is some, but not a lot. Like 0.4% of, what is it, 1.6 billion means that they, divide that by 250 is about 7 million of insider ownership. And obviously I do not know who owns the insider ownership. I'm assuming it's the CEO. And if I look at the salary of the CEO, it was about 11 million, I believe. So one annual salary for this CEO actually is more than his insider ownership right now, which obviously doesn't give him a lot of incentive, and his incentive is mostly based on his high salary. So that is something that I don't like. But I just wanted to share this company with you guys. I do not have any shares in it right now, but from a compound annual growth rate, from a hit by the crisis point of view and current valuation, this seems like a pretty decent investment for the long term. Like, I don't think you can actually normally buy prime New York real estate at such a discount. And the bigger the company becomes, I guess you will find lesser opportunities in that regard, because they will get less hit, less hard or softer by the crisis. So yeah, I think it's at least one to look into, I think, to see if it fits your portfolio from a REIT perspective. So that's it for today, guys. Hope you guys enjoyed it. Let me know down in the comments below what you think of this investment. And if you would like to see more of these kind of videos, please let me know in the comments below as well. And you could also like the video, which will give me a great incentive to make more videos of this sort. So I wish you guys a great evening.